Portfolio Builder members, welcome to our Thursday webinar. Our profits keep growing slowly but surely. This is the boring strategy that just keeps working. And again, today's ROI looks a little higher than it really is because we just wrote the covered call, which again was the 289 strike for a dollar credit. And of course, you may get a different credit. What's important is the strike price and the expiration date. So we're carrying risk from today until next Monday and are collecting a very nice premium of $100 per contract. If you just do that in your head, if we can collect between $50 to $100 commission free using Robinhood, or at least with your discount broker, and we can do that 3 times a week, 52 weeks a year, that adds up to a lot of cash, and it doesn't matter where the market goes. We can do this trade over and over again. If we pull up the trade alert, take a look at our profit before writing the covered call, which is the more accurate profit, was 6.9% with a $37,000 profit. And we've been what I call negative Nancy or Debbie Downer all year. We've been writing very safe covered calls, most of them in the money, which means we were willing to take less profit and protect our cash. And so we've been doing this over and over again, expecting some problems with earnings in the US markets. However, that's not come to fruition. So I've become a little more bullish in the strikes, and our profits will rise a little bit faster while we're doing that. So let's take a look at what happened yesterday. We issued a trade alert to sell the shares, and today we had to buy them back. So we actually realized a profit of $20,247 on the SPY ETF. And a lot of people have been writing in wondering, how do you read the track record? What's your win-loss ratio? And so that is something I wanted to quickly discuss. If you were to look over here, you'd think we've been losing money during this time period. When you look at these closed ROIs showing a negative return on some of our covered calls. But that's not a problem because our underlying asset is going up, up, up. So we can see the profits on the SPY trades are much larger than any losses we've made on the covered call. So what's the job of the covered call? The covered call generates our return when the market goes flat or down. And so this is how we can guarantee we make a consistent income in retirement and how we can protect our capital. So that's the whole point of the covered call. The downside is that we may miss out on some of the growth in the SPY ETF. But the upside is if there is no growth, we just do fine. We make our covered call return and do that 3 times a week. So I have a question for everybody out there who's trying to figure out what's the best strategy for the rest of 2019. And I'm sure a lot of you own stocks, bonds, real estate. And if we look over the past, really over the past, what is this, 18, let's go to a weekly view. I'll zoom it down. You know, if we go back to January of 2018, most investors are probably flat. So for about 16 months now, you've sat on a flat return. You've had a lot of volatility. You've had mostly down months. I mean, if we look at this, we lost money from half of 2018, made a big run up at the end, and then gave it all up, and only to see it come back to even. So you know, I ask you, are you feeling lucky? Are you a Clint Eastwood fan? Do you think to get a return from here that you can expect the SPY to jump to 325 maybe for a 10% return from here? That would mean in the period of 2 years, you averaged a total return of 10%. Maybe, yeah, I would argue that maybe the SPY ETF could go up another 10% this year. And if you are very bullish and you believe Larry Kudlow, we're going to hit 4% GDP, the central banks are going to lower rates and resume QE. Maybe we go to 350. Then we're looking at a 20% return from here, which would still only generate, on average, a 10% return over a 2-year period. And this is while valuations are getting expensive. So our product would argue that, hey, maybe we don't need to try to worry about getting lucky and having everything right happen for us to just buy and hold a stock portfolio. Maybe what is smarter is that we actually start to protect our capital and invest in a product that is highly diversified. And so a lot of you guys end up with a small, undiversified portfolio of stocks. Maybe it's the company you worked for that your 401k was piling into for years. Maybe it's a few companies you really like. Who knows? The rhyme and reason for a lot of people is very oddball, to say the best. But I would argue you're better off with whatever you're doing by purchasing the SPY ETF. And that's because it diversifies your portfolio into a fund that tracks the S&P 500's, America's top 500 companies, most profitable companies. And as that scenario changes, as certain companies become more or less profitable, they're automatically rebalancing the portfolio for you with a 0.09 expense ratio. So there's a very, very small expense ratio. Their average dividend has been about 1.8 every quarter. And so just that is good reason to stop whatever you're doing, consolidate your funds into the SPY ETF, because the second you do that, your portfolio is instantly much more sophisticated, much more diversified, and much less at risk of a recession or bear market in US equities. So the second thing we do is we look at protecting our capital while generating income. And so by, first of all, dumping whatever it is you already own to purchase a much smarter asset like the SPY, we now have a very stable underlying security that we believe will grow in value over time. And if I asked you, in 10 or 20 years, do you think real estate in New York City will cost more or less? You probably have to be pretty crazy to think that it's going to lose value over a long period of time. So when we look at this strategy from a long-term point of view, we can see why owning the SPY is by far the best asset to hold. And then we can start worrying about how do we protect our capital while still generating a return. And so, of course, the big fear is a stock crash. If there's a stock crash, in the short term at least, we're going to see an unrealized loss in our underlying asset. And that's not fun. And if I were someone buying real estate in New York, like an apartment, which is part of a bigger ecosystem, a huge skyscraper, sure, I'm not going to like it if real estate prices in New York drop 10 or 20%. But in the reality, I don't really care because I'm going to rent out that room over and over and over and over and over again and generate a lot of income for retirement. So that's the strategy. That's what makes a lot of sense. And when we look at the type of profit we can make, well, I call it being a Debbie Downer or a negative Nancy, we can still make the 10, 20, even 30% return on our total portfolio with a lot less risk than a buy and hold strategy. So sure, if you want to be lazy, buy some growth stocks and hope to hit a huge run up because everything's awesome, you could do that. Or you could play it safe, be a Debbie Downer, and make money even if the market is flat or down. So let's take a quick look at how we can protect our capital using a covered call in a risk-free scenario. And that's really important because if anyone out there has ever purchased a put option on a specific stock, and I'm sure you've had a very hard time generating a profit from that. And even myself, when I have caught a lucky prediction and a pullback in some sort of stock, do you have the guts to pull the trigger and take the profits at the right time? Because not only do most crashes not last a very long period of time, they just don't happen at all. So trying to be a bear is very difficult in the stock market. And that's what really attracts me the most to this product, is the ability to have a risk-free strategy to make money if the market goes flat or down. And in fact, we even make a profit if it goes up while being the so-called bear. So let's just take a look at how we could have a risk-free way to trade from Friday through Monday using our strategy. Now today I was not a bearish negative Nancy strategy, and we'll look at the news and look at why we went a little more bullish today. And namely, it's not due to the news, it's really just due to the trading volume. You got to realize we now live in a world with trillions of dollars flowing in and out of the US stock market, and it's not being managed by individuals any longer. The artificial intelligence, which is designed by the smartest people in the world, is now dictating the moves of the stock market. It's become very momentous, and so we can see where Wall Street's putting their money into the option market, and that's our best cue as to where to write our strike. And if you've been following us for the last 4 months, I've been very honest in saying every single time I've tried to outthink Wall Street, and it's been primarily being the negative Nancy, we've made less than we would have just following the market's movement. And that's a big selling point to you as an investor, is that you have less capital to trade. So you can be very nimble. You can follow the flow of the market, and you can move your strike price as the market is moving. And I got a quick question. Let me see what that is. Harish says, is this webinar recorded? Yes, it is. And Steve wants to know when we're going to hedge. Yeah, oh yeah, we'll definitely get into that, Steve. So yeah, we'll talk about when we would hedge and why more aggressively than this strategy right here. And Harish is a new member. Everybody, welcome Harish. He joined and is just getting started. So I'll open up the audio for everybody to talk towards the end of this discussion. Let me just see real quick how many people we have on here. It was 17 last I looked. I'll check back. So our audience is growing. We did switch to just a Tuesday, Thursday Q&A to cover all of our products from basic, gold, and diamond, because that way I can have a better presentation, a bigger audience, and then produce better content on Monday, Wednesday, Friday for our core basic program. But what I want to do right now is talk about the beauty of this strategy in terms of our ability to generate profits in almost any market condition and protect our capital. So here's a trade that we could put on right now, which is a risk-free way to make money if the market goes flat or down. This particular trade right now wouldn't generate a profit if the market went up, it would just break even. And so we'll talk about how that works and why we might do a trade like this if the market were actually pointing down instead of up right now in terms of option volume. So this is another important thing to know about options. The lower this goes, the worse it is for our strategy. So the returns we've been generating in all of January have been likely the worst we'll generate for the rest of the year. I suspect we will have a continuation of this collapse in volatility until we don't. And as it spikes, that is the best news ever for anyone who wants to sell options. because the higher the volatility, the greater the yield on the covered call relative to how far it is from the strike. So these profits we're generating are essentially the bare bones minimum we can generate writing the covered call. So let's take a look at this trade right here. Right now, the SPY's last trading price was at 289.88. And I'm agreeing to sell my shares with this covered call for 285. That's almost $5 less than it's trading for. So I'm basically agreeing to about a $4.85 loss the second I put on this trade. Why would I do that? Well, it's because the fellow who wants to buy this option contract is willing to pay me $4.95 on every share. So this is probably one of the smarter speculators in the option market, the fellows who buy these in-the-money call options. Because what that means is if the SPY just goes up a very small amount, they'll start seeing a profit on this much safer option contract that they've purchased. Now, what happens if we sold this and we were wrong and they were right? Well, we're going to end up having to sell our shares for $285 and keep their $5. And so the worst case scenario for us, if the person buying our call option is correct, we make the spread. So that would be about $10 on this trade. And if you use Robinhood, $10 3 times a week, 156 times adds up. That's a 5% return by playing it super safe while volatility is at all-time lows, not all-time lows, but the lows for the year at least. And you'll see as the volatility spikes up, we could buy $5 of protection and actually make a much bigger profit by being wrong. So it's really nice when you can get into a situation where the only way we could show a loss on this particular trade that I'm demonstrating would be if between now, and we've got what, 2 hours and 40 minutes left before the stock market closes today. So our risk, if I put this trade on right now, would be if the SPY were to drop $5 between now and Monday. And even if it did drop $5, Monday, this call option would be worth almost nothing. It would probably be, if we just push the strike up $5, it'd probably be worth $1.25. Or actually less, because time premium will have dropped. Oh, sorry, let's go to 290. So if this had dropped somewhere around the realm of $5, there's your option premium that's built into it. We'd probably make around a $50 to $60 profit covering the position. But what will happen if the SPY does drop $5 in an extremely short period of time? This volatility is going to spike up, and the new covered call we're going to write is going to have a much higher premium. And so that's the beauty of owning the asset and writing the options. Every advisory you've ever purchased that's doing the opposite of this, doing strangles or spreads or anything of that nature, it's really a get-rich scheme that doesn't understand the point of the option market. The option market was built to hedge and protect the rich who own the assets. It was not designed to help little speculators get rich. And so this is essentially setting you up to be the casino, to take the odds and just collect small amounts of money over and over and over again. And if you've ever been to the casino, it's just amazing what people will waste their money on trying to hit a big gain in a short period of time. Now, what happens if we do something more like this trade? So the example we were doing was that 285. This is let's see what the delta is on that 285. Okay, so the delta on this is 98%. Not to say that that's the absolute probability of winning, but most option traders will look at that as statistically the probability of winning that trade. So we enter a position where we have a 98% probability of not losing money by writing that 285 strike. Now, if market goes up, we're not going to make much money. If we did that trade, we would only do well if the SPY traded flat or slightly down between now and Monday. So again, if you want to play it safe in 2019, you got to think really long and hard. Do I want to own a bunch of random stocks at a price point that we have not been able to break through since January of 2018? Or do I want to create a strategy where I make money in almost all market conditions? Do I want to own a ETF that represents the top 500 companies in America, which I can easily manage with one single position? Or do I want to have a whole basket of stocks that are likely highly high risk? And so sure, maybe the stock market keeps going higher. Maybe we get a melt up like BlackRock was suggesting just yesterday. And if that happens, we're going to do very well, but we're not going to make as much money as we would have just buying and holding. But if any other situation occurs, if the market goes flat or down, are you set up to generate profits? And I would suspect that most of you aren't. So let's talk really quickly about how else we can protect our capital beyond the covered call. The covered call is by far the best way to do it because it generates a profit and it hedges our portfolio from downside risk without the opportunity to lose money when we're wrong. The next, probably most popular strategy for generating profits on the downside are really just two main options. One is to buy call options on the VIX. And we have a member in here, Steve. Back in 2017, we had a strategy that was, quite frankly, what I'm making fun of in today's product. And if I had heard about this sort of product that's just trying to make a boring 10 to 30% return years ago, I wouldn't have been interested as a younger fellow. But after 10 years of doing this and really getting to know who the clients are and what really makes sense for their goals at their point in life, this suddenly makes way more sense. And it only works if you have enough capital to own these valuable assets. So the next popular strategy is to buy call options on the VIX. And what the gamblers love to do is not to buy the safer in the money. Let me go to this one. This October strike's brand new, so there's not a lot of open interest. If I look at the open interest, that's just how many contracts are out right now that have not been closed. And we can see there's a pile up of people trying to hedge with a lot of leverage by buying this $25 to $27 call option on the VIX. So what do you have to do to take a profit on this? Well, you're going to have to catch a spike in the VIX, which is the acceleration of the S&P 500. So if we bought a call option on the VIX, not only does the S&P 500 have to lose value, it actually has to lose value in an accelerating motion. So the second the crash starts to slow down, the VIX loses its value. And in our product, we've actually in the past done the opposite. We would sit there and wait for volatility to spike and then short it back down. It was an easy way to get 100% plus gains when the rare instances happen that the VIX did spike. So I'm not a big fan of trying to buy the VIX because it can go for huge amounts of time without any sort of crash. And even if we see a decline in the value of the S&P 500, that does not necessarily mean that the VIX will spike. And so when we buy call options on the VIX, we have a number of difficulties. Number one, we have to accurately predict when a crash will happen. If we buy it too early, the time value is depreciating every day. So that's bad news. Two, if stock market's going higher, that typically creates a deacceleration in the volatility, which pushes the VIX lower, which we've seen all year. And then three, we have to have the guts to pull the trigger and sell our VIX, even if we're right, at the perfect time. And the greed factor sets in. 50% gain, 75% gain, 100% gain. It's hard to pull the trigger, and then you do it too late and you're watching it collapse. That 100% gain is dropping, and now you're going to lose all the value on your option. And then next, you have to figure out what strike. So if I were to be buying any VIX options, I would want to be buying the safest ones that were somewhat in the money or below the strike price, because I have the least risk in terms of one, guessing how high the VIX will spike, and then two, having the time premium eat itself away so quickly. So to make things easier in our basic product, in our diamond product, this would be part two of our defense. Part one, covered call, protects you 99% of the time, generates income. Part two, if we do see the market starting to crash. So Steve says he used to do way out of the money for long-term expiration. Yep. We sure did. And we used to short it back down. And that was a very aggressive growth strategy, which really isn't good for most people. After really getting to know what people need, it doesn't make sense. So in our diamond product, we would use this product, but only after something substantially bad is happening and we're actually seeing the VIX spike. So I would try to jump into the momentum of the VIX if it were spiking, but not before. So now let's take a look at how we've added this to our basic level product so that you can see what we're doing instead of buying a call option. So we recently switched out the some of the tickers in here, and this whole area is now designed to be able to add an extra hedge to our portfolio when the time comes. And again, even though these are just ETFs, inverse ETFs, and an ETN in terms of the VXXB, they still have the same characteristics of buying an in-the-money call option. And so if you're wrong, they lose value quickly. And we can pull up these tickers just to take a look. So this one just hit a all-time high, I think yesterday, which is why this has hit an all-time low. And so certainly when a pullback in tech does happen, this will be a very easy way for our users to buy shares of TECS and ride a short crash for a nice profit. And we'll be doing this at the same time as riding those in-the-money covered calls. So when we do enter this hedge, we want to be generating a good profit from our SPY to help hedge against the risk of owning these bearish ETFs. So we got the TECS, which I would argue is a more volatile version of the SPY in terms of being able to capture profits in downturn. And then we have the VXXB, which again only does well if there's an acceleration in decline, not just a pullback. So there you go. When the time comes, we can definitely jump on the bandwagon and make money on the downside greater than this $50 3 times a week. And let's just talk about what would we do to actually do that. So if I thought that we were in a correction phase of some sort, some magnitude, what we might do is drop down to a 70 on the SPY take profits on the TBT. Most likely, a TBT is going to rise with the SPY until we get some sort of crash. And at that point, we don't know if it's a real crash, if it's going to be a big crash, small crash, medium-sized crash. And with our program, we've designed this so that we're pretty much crash-proof just from the covered call. But to make extra profit, we would likely go into an allocation, something like this. That would be if it was a very violent pullback. If it was just getting started, I might do something more like 80, 10, 10, and then slowly jump into the inverse as we see a crash developing. Again, this is not, the market is not leveraged to do anything but go up. We have all the banks lending out money like it's monopoly money right now. So concerns for a mega crash right now are low, despite what all the hedge funds who manage bonds would try to scare us into believing. So just to kind of re-summarize, if we were to play it safe and do those very defensive covered calls, and the market were to still go up, we can generate at least a 10% return on capital. If we write strikes that are near the money, right around the trading price, we can jump our profit range to the 20 to 30% range. And if we get bullish for whatever reason and we write our covered call $1 or $2 above the trading price, we can essentially double the return of the S&P 500. So we can enjoy the upside of the underlying asset plus take this money from the gamblers who are predicting the SPY is going to jump $2 to $3 in a 48-hour period, which just rarely happens. So that's the overview. You got to think really long and hard. What assets do I own, and what risk am I holding on to? And what has really happened in the last 18 months? Has anything dramatically positive happened for the stock market? We had the tax cuts, which gave us a nice rally. We have trade wars, which are obviously not a positive. We have central banks easing monetary conditions, but that's because they're scared of a global slowdown. So, you know, the Clint Eastwood phrase really comes in handy here. Do you feel lucky? If not, maybe our strategy makes a lot of sense. We just own the asset and rent it out for the rest of our life. If the market's going lower, we're going to write that covered call below the strike. Market's heading flat or higher, we'll be writing it either at the money or above the trading price. And so that's the name of the game with this product. We have a few extra bells and whistles, which namely allows us to get extra profit if the market is heading lower. But that's a tough game to follow, and anybody who's tried to short the market knows just how hard that can be. I'll do a quick little review of some of our other services, and then we'll open this up for Q&A. So our current product, which retails at $9.97 a year, we do have a discount of $100 if you call in. That product gives you our basic program, which trades the SPY. You're going to need at least $15,000 at Robinhood. If you sign up for their gold plan, they'll let you use one-to-one leverage. So with $15,000, you could get started. You could buy 100 shares of the SPY and start writing your covered call. And that's a great program for most people. It offers the most security because we're following the price Monday, Wednesday, Friday. And if need be, I will issue an emergency alert on Tuesdays, Thursdays. We're already meeting on Tuesday and Thursday for our webinar, which is optional. It's just a Q&A and for everyone to get a feel of our community, but absolutely not necessary. For those of you who are a little more advanced or have more capital to put to play, we do have some other products. One of which is our cryptocurrency technology, which is has a great return. It started off the year losing quite a bit as the cryptocurrency market was fighting against the Fed, really raising rates, pulling cash out of the economy. Same thing in China. And now the reverse is happening. And of course, as the monetary supply increases, the minute value of cryptocurrencies grows. And so market cap on crypto is tiny, but this is a product that's included in our diamond level membership. And we'll see. It's been going up kind of unexpectedly, just starting April 1st. There's a huge spike. We have our emerging markets portfolio. Trade alert for that program today, for all of you wondering, was to not write the covered call, to just own the assets. So I am expecting a potential strong growth opportunity in this part of our portfolio where the covered call wouldn't necessarily make sense right now. And this is a much smaller part of our portfolio, so that's why we're willing to take more risk in this portion of the strategy, especially while China is printing money at a faster pace than they ever have in history. So this is their key partners. Gold and silver would benefit from expanding monetary supply. They have had a hit recently, but I think that short term. Also, the central banks are just loading up on gold like nobody's business. So I think this is a good portfolio that's very passive, and you can build it and sit back. This is part of our gold product. We publish content on this on Tuesdays, and right now we recommend no more than 25% of a $200,000 portfolio be allocated into this asset. Thursdays sorry, emerging markets is Thursdays. That was today's class, and that's what came out this morning. On Tuesdays, we offer a more advanced strategy that's very similar to the SPY program. So if you have $150,000, you are in a group of investors that have special privileges. You can basically rebuild the SPY ETF and the QQQ ETF by hand. And when you do that, you get a much higher premium from writing covered calls. You also benefit from corporate buybacks. These companies have the greatest profits in the world, and they are using those profits to buy back their own shares. That's why this small group of companies has greatly outperformed the S&P 500. And if you believe we live in a world where winner takes all, these are the companies who are taking it all. So perhaps it's actually a safer long-term asset than the SPY if you believe these companies will continue to gobble up their competitors. So if you do this program, you end up with 300 shares of Microsoft, 100 shares of Apple, 100 shares of Facebook, 100 shares of Intel, 100 shares of Cisco. That 5G story is driving Cisco straight up. A lot of analysts are expecting a huge explosion in Cisco in the next few weeks, which we're also seeing in our market data as well with the covered call we're writing. And so it has the same strategy in terms of asset allocation. We use this to move the money around into the different sectors. And this one has really performed well. It has twice the return for every dollar invested to the SPY, and it only trades once a week. The catch is you really do need to have more capital. So if you had $75,000 at Robinhood, they would let you double that with margin, and you could fill this portfolio for that amount of capital. You could also turn off certain sections. So if you wanted to follow this with a little more risk, you might turn off the Microsoft position, which would reduce your capital needs by $36,000. So you could get in a little smaller portfolio size and still get the benefits of this program if that is something you're interested in. Now this program is much more expensive, and it does generate a very nice return. This one starts at $5,000 a year, and we do have a discount over the phone if you want to join that program. One bonus we do have right now, and I'll pull up the phone number. If you do upgrade your membership from a free trial, we're giving out a 90-day free trial to the Diamond program, which includes the emerging markets. So you get a taste of all our products. For a lot of you, the SPY program makes the most sense. It has the most protection You're getting to interact with me the most often, and you're able to move that strike price more frequently than we do in the diamond program. But if you're looking for bigger returns and a little more risk, perhaps that's the greatest value in our diamond program. Take a quick look at a few other charts that are important to our strategy. Dollar remains strong. We're looking for a weak dollar before this emerging market play would probably take off. So that has not happened yet. And that makes sense. The Fed is really the most hawkish central bank out there right now, with Europe just sticking to almost 0% rates, and Bank of China doing record stimulus to try to keep their economy growing. Leading indicator with the South Korean stock market, little tick down, but in general continuing its rally. If you listen to the bond experts, they're basically looking for this pattern to reverse itself over the next coming decades. So they believe that inflation will work its way into the system and force the central banks to raise rates. So that'll be interesting to see. Japan, however, has managed to have low rates and a stock market that's not made a new high for some 30 years. But what they're doing is leveraging their GDP and buying world assets at record pace. So they were one of the biggest buyers of the US stock market. And that prediction is also something we're using with this TBT share. So if rates do rise, which could be a play on America to punish other currencies, then this TBT ETF will really rocket higher. So if we get back to something like a 5 to 6% rate, which is the 200-year in America, this ETF would trade at 140. So currently we have a 10% position in this, and I'm expecting it to steadily rise as the stock market rises. Now, if I'm wrong and the stock market goes down, these rates might go a little lower, maybe not, but we may not get that upside value. But I do think when the TBT hits somewhere around the $60 mark, that would be a good signal to look out below, because now the rates on the long-term treasury will be so attractive that it will put some serious competition on US equities. Okay, moving forward. Inflation is supposedly what the central banks are mostly concerned with, and not stock prices. However, we did see that they clearly do care about stock prices. But we've entered a world where corporations can produce goods for less money, and they're making a lot of profit from that. And it looks like there's no inflation. So for the average consumer, our wages have stayed relatively flat. Rent has gone up, house costs have gone up, but food and things like that are flat or down. And that's, the Amazon effect. So we'll talk a little bit about some of the policies that are coming through the US government that could potentially create hyperinflation. And if we look at what happened from this period where we did have rates skyrocket all the way up to 20, it's a whole bunch of policies that were very progressive, very mainly just creating a lot of inflation, creating Medicare, Social Security, all kinds of policies were put into place as we entered a Cold War with Russia. So there's a lot of parallels right now. We've got the opposite of those sort of strategies with Trump. But assuming he does get reelected 2020, and we continue to see this, the rich get richer and the poor just stay the same, I would suspect that we do get some sort of progressive Democrat in 2024 that's going to essentially create a lot more debt and eventually create another inflationary run like we had during this period. So if we look at the Dow over 100 years, that's really the story that potentially is replaying here. Maybe we have a few more years of good stock market, but then what happens next? So if we do reverse this process, that was a 30-year wait to break even from 1965 to 1995 just to break even on the Dow. Now with our product, riding the in the money covered call, we can protect against that and generate our same boring return. And so that's something we're watching. You know, are we something like 1963? Couple more years of strong bull market and then an unexpected crash that lasts for a decade and a half. All right, moving to the treasuries. US treasuries are being artificially kept very low. Plus, we've had a huge flood from broker dealers and retail, especially the hedge fund space, piling into to the bond market. And to make what? If they believe the Fed's going to push inflation to 2%, that means we're agreeing to make a 0.5% a year return. In fact, the Fed's now saying they want to overshoot 2% inflation. So the bottom line is that we have, number one, the Fed artificially pushing this rate lower to help prop the stock market. And then two, we have a lot of people speculating that they can make money just flipping the bond. They're not actually trying to make that yield, because who wants to make 0.8% a year for 20 years? You know, they really want to flip it. So when that flip happens and everybody starts to sell their bonds, it'll be interesting to see if we get a huge spike in that 20-year yield. And if so, that's why we want to own the TBT outright without the covered call. So as this rate rises, that would become more and more problematic for the stock market, something we're watching carefully over time. And let me pull up my PowerPoint from the video today. I'll flip through that and then we'll go into some Q&A. So at any point in time, there's always a bullish and a bearish case for the market. And that's where the risk is entailed and why we can make a handsome return taking the risk of owning the SPY and then letting someone who can't afford it buy the option to speculate on how high it will go up in a short period of time. And so we'll look at some of the news that's hit yesterday and today and my 2 cents. And again, every time I've tried to outthink Wall Street in terms of looking at the strike price, where the volume's flooding, I've been wrong and the market's been right. So sure, we want to have a bearish edge with this product because our clients need to protect their capital and make a safe return. But it just goes to show how hard it is to outthink the market. Okay, after a slump in January, retail sales are popping. Typically, initial jobless claims will start to rise into a recession, and they continue to get lower and lower. So the job market looks strong. Of course, Ray Dalio says that's going to create rising wages, which is going to compress the profit margins for corporations. But that's not true if they're automating more and more of their production line. And so I think this is part of the reason why there hasn't been any inflation, is because the cost to produce goods has dramatically dropped. They haven't dropped the price for us, but they sure have increased their profits, and all that profit's flying right back into corporate buybacks. Stock market is at risk of a melt up, not a meltdown, warns BlackRock's Larry Fink. So these big hedge funds, proud to boast, 100 to 200 billion in assets. Most of them manage bonds. We got Ray Dalio, Stephen Druckenmiller, and my favorite, Jeffrey Gundlach. But that's peanuts compared to what the BlackRocks of the world manage. And so they're up to 6 trillion. They just changed their company structure. I have to learn a little bit more about it, but he thinks they're going to add another 4 trillion as they expand to get all the rich folks out of China into their company. We got JP Morgan with Jamie Dimon, as well as BlackRock, basically saying, hey, emerging markets is the place to be in the next decade. That's where we're going to focus our efforts, not only for investment from the Americans, but also to bring in new investors. And so that's why it's important to definitely take a careful look at our emerging markets portfolio and consider at least putting a little bit of capital into that so that you're gone through the motions and you're ready to make a bigger bet when the time comes. Because now they still haven't outperformed, but that might change. U.S.-China deal is aiming for late May. So this keeps getting pushed. My belief is that they're just gonna, let's buy some soybeans and say to be nice, and we'll push this till after the election. That seems to be what's happening. So we'll see. I doubt that America is going to become more aggressive and risk a stock crash, at least on purpose, leading into the election. So we'll see. Trade deficit is improving. So we're looking at the greatest jump in the U.S.-China trade balance ever in a short period of time. So we'll see how that works out. China came out with growth in the GDP, which was unexpected, as their growth has been declining for quite some time. But it's still 2 to 3 times that of America's. Now, of course, can you trust the economic data coming out of those? Hard to say. And probably the big reason for their pickup is because they have unleashed more monetary stimulus than ever before in history. And so the main thing that bounced for China is their retail growth year over year, but we're still seeing problems with the imports. So they're not buying as much as they had, which is causing the global slowdown, especially in places like Germany. And real estate land purchases are still lagging, but I do believe that this credit boost will be very bullish for emerging markets. So time will tell. One very concerning thing is that their energy consumption has dropped, and that's a pretty hard stat to fake. If we're using more energy, that usually means growth. And the soybean exports have plunged, so most likely this will be the one thing that is fixed quickly with some sort of U.S. trade deal. What would in the party for China would simply be inflation. You can't print money forever. Once you've printed more money than your economy has really grown, typically you get inflation. So that's the thing to watch out for, is the PBOC, China's central bank, starting to point out that they're going to tighten monetary policy. So Argentina is a tiny little country that's always got problems. Just a good illustration of what we'd be looking out for. German PMI has a little uptick, so they're getting a little more business thanks to the China print. And meanwhile, the City Economic Surprise Index has dropped very poorly relative to stocks flying higher. So that's definitely a concern in the markets. Sentiment is slowly starting to pop back up, which is usually a good leading indicator. And and so I think there's still room for some profit taking both in the bond market. Everybody's speculating that the rates would drop, hit a win. We're in that early, like in December. which was betting against what the Fed was saying would happen, which was autopilot QT and automatic rate hikes. So anybody who did buy those bonds back then is sitting on a huge profit and will likely take those profits, especially people like Ray Dalio, who use leverage and basically bounce back and forth between stocks and bonds. And so they have a profit on both sides. Parity funds have a record-breaking first quarter in the last 30 years. And so they have an opportunity to sell their stocks and their bonds at the same time for a profit, which I think will happen. I don't think we're going to get a huge crash, but again, that's just something I've been expecting for about a month now, and really why we've been trying to so-called outthink the market, which has not worked. I mean, we've made a great profit, but we didn't make as much as we would have just letting Wall Street tell us where to go. Who's buying all these stocks? It actually wasn't retail, and it wasn't the hedge funds. It was primarily the Bank of Japan and corporations buying back their own stocks. So we don't have to feel too bad about not hitting the world's fastest growing stock market this year. Most people did not. And if you're retail, you probably are just flat from now 18 months ago. So not a lot of people were taking huge profits on this rally. If anything, just making back the losses that they had experienced from the Christmas massacre. And so Jim Reed of Deutsche Bank says the downside to the numbers will be possibly a more hawkish PBOC. So that's something we'll keep a lookout for. And now they're going to stimulate the car industry. So they're just really stimulating everything on the retail side right now. Bridgewater thinks we're going to have a 30% crash in the dollar in the next 10 years, that we're in the 7th inning of the stock market, and that there's doom and gloom ahead, 40% crash in equities if the profit margin on corporations starts to reduce. And so that would assume that their biggest cost was labor. So that'll be something to watch. What the companies have done this year has just been very doom and gloomy, marking down their projections, and then right when the earnings come out, popping them up with a good surprise. And so that's helped fuel the stock mania. You can see US profit margins are much stronger than Europe's. And so this is why we have low inflation and little risk of the Fed jumping rates right now, at least based on CPI. All right, that's okay. They do a survey with the hedge funds. Most of them don't see a recession till 2020 quarter 2 or 2021 and beyond. Of course, they never predict recessions accurately. This is a chart you can go through. There's always some fear in the market that the market is climbing a wall of worries. So that outlines this. Our video today did have this full presentation. So we're starting to run out of our hour. And we've got Andrew Yang wants to give everybody $1,000 a month. Not enough to replace your job, just enough to help out people in tough spot. And so policies like that, or Medicare for all, that's something that I'm a little more worried about in the 2024 election in terms of really screwing up the economy and creating inflation and potentially crashing the stock market. So you promise free money to a bunch of people. It's certainly going to get a vote. We'll see how well that works this election. And all right, let me open it up for some Q&A. Let me find where our chat box is. Okay. All right, I'm unmuting everybody so you can chat. And if you don't want to be heard, you can mute yourself. Anybody has loud audio, I'm just going to mute. So if you do want to chat, let me know. I can unmute you. M. Gress, free trial member. How's it going, Steve? You out there?
Right. Yeah, you have the data, but not.
Arish, how's it going? Welcome. I think this is one of your second webinar, right?
Yeah.
Nice.
Well, yeah, the card could have changed, but there's no way for us to automatically.
Well, what questions you guys got for me today?
How come you sold your shares on Wednesday? The SPY shares.
Well, yeah, you could have like a refresh.
Well, yeah, I'd like to tell you I had a crystal ball and knew that the SPY shares were going to crash a little bit yesterday, but it was just pure dumb luck. It was a scheduling thing, so we got lucky on that one for sure. I mean, we would have had a covered call instead, probably would have protected us.
So yeah.
I mean, yeah, if I had collected $1 on a covered call right at the money, you know, we'd actually have made more money if I had done that. So yeah, the issue was we have no trading day Friday, and so if I had wrote the covered call Wednesday, it would have been for 24 hours. So we just decided to take the profits and do everything today. So that was just a day off.
Oh, so you did not write a cover call for Wednesday.
Wednesday's alert was to buy your covered call and sell your SPY shares because Friday was off, so we were going to push the trade till today. And for a lot of you, I don't want you having to worry about what's going on with your SPY shares and not have protection. So yeah, we looked like some sort of market genius who knew that minutes later the SPY was going to have this crazy crash, only to rebound. So it wouldn't have mattered. But no, it was a purely scheduling fix for the product.
Okay, thank you.
Yeah. And so I'm never going to leave you guys just hanging on your main position without protection. So the covered call is our protection. So I'm not going to have you just own the SPY without protection. Not in your position. Going into retirement, this is your nest egg. We have to protect it. Number one rule is don't lose money. Harish says, very good explanation. Well, thanks, Harish. I appreciate that. This is the boring strategy that just does the same thing over and over and over again. There'll be a little excitement here and there. If a market crash really does start to take place, that's when we'll put some money in those inverse ETFs, especially techs. I mean, this one. Let's look at the all-time. Whoo! That's just insane how much that thing has crashed. Yeah, I mean, these prices don't even make sense. I don't know if that's even real. Let me go to weekly. But look at that. We can go back to these shares trading at $850 in 2013 and crashing all the way down to 13. So imagine we get a .com bubbles type crash in the tech. Woo! 10% position in techs is gonna put a nice profit in our total portfolio without, with risking around 10% of our portfolio. So yeah, that will be the excitement whenever that happens. And we're not going to try to predict it before it happens. We're going to just jump on the boat and go with the flow. And that's the big advantage of being a little guy. You can buy and sell your equities instantly. You can get filled very easily. And so you can go with the market movement. And because you're showing up Monday, Wednesday, Friday, you watch my little video, you're going to know more about the stock market than you probably want to. So you can feel confident that you're not just completely just guessing, I guess. You'll know everything going on that's important, and you'll do your boring little trade. If you want to have a little feeling of community, Tuesday, Thursday with our webinar group. And that's it. We're going to do this for a long, long time. But I really like looking at this right here. You know, sure, dang, that's a nice rally. But we look at the bigger picture and we kind of zoom it out. Well, the stock market actually really hasn't done much, has it? In 2 years, 2.5 years, it's kind of just gone sideways. So, you know, we got this feeling that it's going to go up forever this year, but maybe it won't. Maybe it'll go flat, slightly down, bounce around. You know, are we going to really get a horrific crash, a panic? Maybe. But you look at the grand scheme of things, these are actually just mini crashes compared to what we saw in the 60s. So it just helps everybody play it smart. Let's stop owning specific stocks. Let's own a basket of the best with the SPY. And then let's use a covered call to have a risk-free way to protect our capital. And sure, if the market's crashing, let's put 10%, 20% max into the inverse ETFs and benefit from that even more so. We're not going to do that until something really wrong is happening. You know, Trump comes out, says he's going to raise tariffs, China's not playing nice. That would scare me. I would definitely react to that. But just because the VIX is low doesn't mean it's a good time to buy it. And I know Steve was asking me, well, should we buy it right now? It's low, it's cheap. Not worth it. Let's just wait till it starts to pop, and then we'll buy it. It's going to be a quick flip. Probably within a month, we'll sell it. Maybe 3 months at the most. Unless, you know, we have central banks saying they need to raise rates because inflation's skyrocketing, but that's just not happening. We're not getting inflation, and the banks aren't raising rates. So money's cheap. It can be borrowed. You look out into the future. If I can borrow for 1 or 2 or 3% and try to make 4 or 5 or 6% in U.S. equities, you can see why people keep piling into these trades. All right, guys. If I have any other questions, shout them out. Otherwise, we'll be ready to buy this covered call back Monday and write a new one. Nice and easy. All right. Well, I really appreciate everyone's time. Thank you for taking the time to join us live. Again, Monday, Wednesday, Friday, noon Eastern. Expect the next trade alert. We're a little late today. It's my bad. I apologize. Had a issue with my recording. I had to restart it. But I do want to be very punctual and have that at noon Eastern, like clockwork for you. So in terms of being anal about things like that, I usually am right on the money with that. So I do apologize for the delay today. Tuesday, Thursday will be our new webinar time at 1 Eastern, and that will support all 3 products, so you can get your questions answered for all 3 at the same time. And that's it. That's the plan. We're going to stick to it. See you guys next week.